This is just a quick question.
Uh,
Yeah, that's
well, class. If you,
sure.
yeah.
Just. Hey, I just heard somebody sign in to Zoom. How's the audio? Can you hear me? Okay. Um, Malavi, you're on mute, so I can't hear you. But I'm trying to confirm if you can hear me so we can get good audio for the Zoom recording. Okay. Testing, testing. Sorry. Let's try another one. Okay, testing, testing. All right, we'll go with that one. It didn't sound like we had great audio, but okay, there's a chat. Okay. You were telling me that you can hear me, so we'll go ahead and get started. Okay, Seth, you had a question for me. Okay, thank you. Yeah. You hit me up via email, and if I remember right, I said we'd address it at the top of class, but I don't remember what the question was. What was the question? It was about where the heck do I get started with this research report? Okay, let me show you where to get started with this research report. The one that I have saved out there online is 70, 80 pages. So I understand the sense of overwhelm. I try to give some inside tips every week when we get together to hopefully spur you along. And I have mentioned in the last couple of class periods that you should start with investor relations, download the sample report that's out there on the internet so you can get familiar with the format that I want to see it in. Go to investor relations, try to get a presentation or an investor report. That's the quickest way to get on top of the story that the management team wants you to begin to internalize. Last week, I gave a tour of all the resources that were available through the Block School. So if you weren't here last week, watch that video, try to go out to the Miller-Nichols library and begin to gather source material. Then it's just, you know, it's work. You begin to pour through those, cut and paste as you see relevant material. Tonight, we're talking about Module 3, which is a breakdown of the return on equity ratio. I'm going to give you a lot of insights into, you know, how we look at that as analysts. But then the database that we looked at last week that would be relevant for that would be the ProQuest database. And then I have requested access for everybody in this room to FactSet. And I would give you a tour of FactSet. I'll try again tonight. I haven't had luck accessing it from Block School computers. I don't know why, I just don't have luck. But you should get a invite to set up a login, and if you just navigate the menus out there on FactSet, you'll find most of the information that we're looking at in this class throughout the semester. Okay. Then, 2 semesters ago, UMKC stopped paying for Morningstar, which is very unfortunate for you all because Morningstar is a great place to start this research project. If you happen to live in Johnson County, you can go to the Johnson County Library and get access to Morningstar. So get yourself a library card, go out to their website, and you're going to want to click through to the databases. And then Johnson County will give you access to nearly as many databases as the Miller-Nichols Library. And I'm pretty sure it's the same thing with the Kansas City Public Library, although I won't swear to it. So these are just other resources that are available to you. But the one I wanted to point out was Morningstar that we used to have access to here at the Block School, but we don't anymore. It's an excellent resource. Last week, we talked a little bit about Mergent. It's available out here too. Morningstar Investor Center, access now. You'll need a library card and PIN number, which are easy to get. You click on Morningstar and it takes you out here to this site. And Seth, what are you working on this semester? What company did you pick? Lowe's. Lowe's. Okay. LOWE. Is that the ticker? What's the ticker for Lowe's? Or is it just LOW? LOWE? All right. Well, we can look it up here. Okay, so anyway, LOW is the ticker for that. So you type it in. Okay. So here's the Morningstar report. And Morningstar has summary, analysis, price to fair value, sustainability. You can click this little download button over here. You want to download the investment detail report. That report is being generated, and there it is. So let's open that. Well, see if we can get an equity report downloaded. Okay, that's a little better. Okay, great. So we have a Morningstar report here that's, well, we got 18 pages. And remember, I told you that I wanted this research project broken down into a cover page, which is the most concise kind of summary of the whole research report, where you hit the management, mispricing, and risks and conclusions. I want an executive summary, which is 10 to 20 pages, just like this Morningstar report, and everything else is appendix, where you're gathering data to support all the modules that we're covering this semester, and you're breaking down any relevant material. So if you're doing a report on Southwest Airlines, the module 10, where we cover leases, is going to be a significant part of your appendix. But if you're doing, I don't know, some other company that doesn't have any leases, then that part of your appendix may simply read module 7, not applicable, no leases. You'd be done with that part. So it varies depending on company. Morningstar is an outfit that I hold in very high esteem. Their framework to investment research generally aligns with the way that we present investment research in this class. It's a great place to start. If you want to look at a research report that, broadly speaking, falls into the same format that you're looking for here, start with Morningstar. So you get a big head start. You're probably going to be able to use a lot of their material. What I'm going to be looking for is how you compare and contrast to this with your own analysis. I gotta have some analysis. You got to draw some of the points out that we're working on in 16 weeks. So I'm going to want to see that you've properly cited it and that you've backfilled with a little bit of, this is what I agree with. When I look at Morningstar's research, I think the analysts did a great job here, here, and here. This is what I don't agree with. That probably aligns more with the fair market opinion or bull market opinion that's more commonly found through Morgan Stanley or Goldman Sachs or Bank of America or where else you happen to find it. And maybe it's the management team. Cite that, take those considerations, pull them into your discounted cash flow analysis, which we'll cover in module 11, and you'll be almost there. Okay. Did that cover your question? A little bit help? Okay, we have another question over here.
Yeah, mine's mainly on the format, looking at the examples. Is the only thing you want to say MLA format, is the only thing you really want MLA format is the citation, it's not the body of the text itself.
It should be in the body of the text itself too, although.
Yeah, I mean like the fonts and being times in Roman and 12-point double space.
That doesn't matter.
Okay.
And I didn't even know that was an MLA thing.
Okay, yeah.
Okay.
That was my question.
So what I found was there's a video on the site that teaches you how to use the citation tool that's built into Word. And after you watch that video and do it a couple of times, it becomes pretty user-friendly. So as you're building this report, there's a template out there on Canvas. That's a Word file you can download. Download that file, and as you pull these source documents from Morningstar, from the Miller-Nichols Library, from FactSet, from Bloomberg, go in there and click on the references button in Microsoft Word. And the video on our YouTube site will show you how to do this. And then a little dialog box is going to pop up. And the dialog box is going to ask you for the publication, the author, the year, the website, a couple other prompts. Just fill in where you got the source document. And then anytime you cut and paste from that source document, you'll go back up to the references, you'll just click on the reference button, and it'll pull up a list of every reference you've typed into that document. And you may hit source number 5, source number 3, source number 2, source number 1 as you're compiling all this. And then when you're done with the report, you just hit update bibliography, and you're done. So that works pretty well. If you run into any problems, just let me know. But that's, thank you for asking a question, because that's one of my shortcuts when I'm grading these research projects, is that citation. If you've done the cite, I've graded enough of these to know now that if you've done the citation well, you've done the work well. So when I get to the end of the semester, I have to grade the 30 of these, and I'm going to procrastinate until the last weekend. So I have to grade 30 of these in 3 days. So that takes some time, and I've kind of learned what the A papers look like and what they key in on, and one of those indicators is well done, works cited. So we're 3 weeks in. I'm going to lecture on module 3 tonight, which is all about return on equity. You all should have established My Business Courses login. You should be on module number 3 homework. So that's 30 points worth of homework. You should have identified a company that you're working on. You should have done a proxy analysis so that you know how the management team gets paid. And next week, we will begin thinking about that first exam. So what questions do you all have before we just jump into a lecture on module 3? Anything smart from the Zoom crew tonight? Okay, no problem. We can go straight to the lecture. Module 3, profitability, analysis, and interpretation. Most of this has to do with return on equity. We're going to break it down 2 different ways. We're going to look at a typical DuPont analysis. I expect a lot of you have seen a DuPont analysis in your finance prerequisites, so hopefully that'll be a review. Hopefully the first 4 modules is mostly a review, and then we pick up speed moving into module 5. This is a review of the key ratios that I want you all looking at when you're breaking down the companies that you chose. I want you to take a look at the DuPont analysis. You can find that on FactSet. I think there's a tab for it on FactSet, so you don't have to break down these ratios yourself. It's all been done for you. That's the nice part about finance. You're going to find yourself working in a career that has access to some of these tools. Rarely, if ever, you're going to have to calculate a ratio in a spreadsheet. It's all just going to be given, and that's fine as long as you know how to calculate it, because you need to know the constituent components. When return on equity increases, you need to know what's driving it. And then the next question is that sustainable or something that I could factor into some type of growth curve? Because finance is the business of trying to predict the future and make educated decisions from that data, whereas accounting is a field where we're trying to accurately portray the past to the second decimal point. So you'll hear me point out some areas, especially tonight, where the ratios can be, you can use them several different ways. Module 3 was 80 pages. I won't have time to cover all 80 pages, but I went through and made some notes that I wanted to make sure I hit tonight. The first one is the basic formula of return on equities. Our authors get very technical. Take a look at this formula. The numerator is net income. The denominator is average stockholders' equity. So in the numerator, we have net income, which is the balance sheet term. That's the amount of money that the company earned over a 12-month period. Well, that takes 12 months. A balance sheet is a point in time period. Most of the time you see return on equity is net income divided by equity. But the technical correct way to calculate return on equity is average stockholders' equity. So you would take the January 1st equity number and average that with the December 31st equity number, and that becomes your denominator. Okay, I see some heads kind of nodding along that. Yeah, that makes sense. I've never seen it that way in practice. Never seen it that. And that's my point about accounting being an exact science and finance being a big messy ball of estimations and judgment and guesses. In accounting, you need to be right to the second decimal point. In finance, if we're directionally correct, meaning up or down, we can make good decisions about our future. You know, we're trying to predict whether a stock will go up or down. And that's why I don't typically see financial analysts get that technical. This book was written by a couple of accountants. I am a CPA, but I don't practice as an accountant. I practice as a financial analyst. So as a financial analyst, when I'm trying to make quick decisions and a lot of quick decisions for our clients, and I recognize that there's no such thing as a second decimal point level of precision in the field of finance. And all financial analysts think this way for the most part. Well, you'll just see them use equity. Okay, now you have to have the wherewithal to remember, oh, I did take financial statement analysis 419 or 5561 10 years ago with Vern Fishenberry. So if you've just gone through a big merger and your equity at the beginning of the year was 10 million and your equity at the end of the year is 100 million, okay, now you might have to hit the pause button and make an adjustment, but that's rarely the case. And it's not going to be the case for any company that you're looking at this semester, because we picked from a list of dividend aristocrats that have been operating for decades and steadily increasing their dividend. That's purposeful because I want everybody in this class to be looking at a company that lends itself to not simple analysis, but traditional or conventional analysis. So yes, this is the right formula. Don't use it. Just use equity in the denominator. It'll be fine. Now, when you're on the exam and you're taking questions that were designed by our authors who wrote the book and have built the My Business Courses website as a nice complement to that book, yeah, you probably need to be using average. But as soon as you're out in the real world, done with me, I think you'll find that equity is a just fine measure for determining a company's return. Okay, next of the finer points I wanted to make about return on equity is that, and our authors factor this into the formula here in another slide or two. Return on equity is return on equity to common shareholders, or return on common equity. I think it was night one, we talked about minority interest shareholders. I think I might have used the example of Berkshire Hathaway. If you're Berkshire Hathaway or another global conglomerate, then you've engaged in merger acquisitions for years and years and years. And a lot of times those transactions unfold in a manner that the acquirer will buy 90%, 95%, 99% of the acquiree, which still leaves a minority interest because you didn't buy 100%. And we account for that on the financials. When you get down to the income statement, there will be a line that says income attributable to minority shareholders. And you see that right here on Pfizer's income statement. You have net income attributable to common shareholders, and then right above it are non-controlling interests. So what we're interested in is the common shareholder. Get more on that here in a minute. Right. Let's talk about the DuPont analysis, and I'll mention more about this NCIR ratio. Okay, the DuPont analysis takes return on equity And we're gonna break it down into its constituent components. Return on equity is first return on assets. So we take the net income divided by assets, we get return on assets, and there again, it's average assets in the denominator. We multiply return on assets by financial leverage, which is the average total assets divided by average stockholders' equity. There again, just take assets over equity in practice. And then this is another technical aspect that I've never seen used in practice to reflect the share of return on equity that's attributable only to common shareholders. We're going to make this little adjustment off here to the right that says times NCIR, where NCIR equals the non-controlling interest ratio. I'm going to show you another slide here in the back of this deck that looks at the non-controlling interest ratios for the S&P 500. They're almost all less than 1%. So, what is the likelihood that if this number is less than 1%, it's going to affect any decision that you're making with this debt? Very, very low. So unless you have a significant non-controlling interest, you can just forget about that little tail right there. But I wanted to point it out because non-controlling interest is a thing and we have to be aware of it. And if ever becomes material, then your analysis changes entirely. You'll hear me talk about materiality a lot in this class. And materiality is it's a huge concept for anybody in the field of things. Again, we have thousands, tens of thousands companies to invest in and analyze if you're in the world of portfolio management. So that requires speed and efficiency. And materiality is a concept that helps us discern whether or not something needs our attention or if we can ignore it. And when you're working on your research projects, any of these modules can be deemed to be immaterial. And in that case, you can check the box and move on. I used the example of leases with Southwest Airlines. Definitely going to be material for Southwest Airlines. Probably not going to be material for most of the companies that you're working on. Non-controlling interest is going to be immaterial for every company that we're looking at this month. How many people in here, how many of you have management teams who are compensated in any way, shape, or form on return on equity? Did anybody see that in their proxy? No return on equity. Okay. Any return on assets? Return on net profit margin or return on invested capital? So how about gross margins, profitability margin? Okay. I'm guessing the rest of you saw some convoluted metrics tied to stock price appreciation over maybe a 1, 3, 5-year period. You might check again. Return on equity is actually a pretty common thing to tie your management team's compensation to. And I don't have a problem with return on equity if it's one of several sources. What I do have a problem with is when it represents an outsized proportion of what a management team is compensated to, and it's being manipulated, and it's easily manipulated. Because return on equity, well, I'll just break it down for you. Firstly, we're going to look at return on assets, which is net income over total assets. And I want you to think about return on assets as the return to the total company. Company is going to be financed partly with equity and partly with debt financing. If we lump both of those two things together, we get return on assets. And that's a better measure of a management team's call it skill level or talent level, that's what they can control. They can control all of the decisions that they make or with the total assets inside the company. So we're gonna take, income over assets. Here's the calculation for Pfizer at 16.6%. But I was looking forward to. This is Pfizer's non-controlling, ratio. What's the I stand for? Non-controlling interest ratio? Yeah. Okay. Non-controlling interest ratio, 1.00188. So it's immaterial. Okay, here's the disaggregation that I was looking for. We have return on assets equals net income over average total assets, which is broken down into its two components of profit margin, income over sales, times asset turnover or sales over average total assets. When we look at return on assets, let's say hypothetically, we see return on assets going up over time. And I think might be the last slide in this deck. Our authors talk about vertical and horizontal analysis. Well, horizontal analysis is simply looking at these ratios over time. So I like it when students will put together a little graph that show return on assets, return on equity, and its components over time, so you can see how it's trending. If you're looking at return on assets and it's going up over time from 16, 17, 18%, the next question is that being driven by profit margins or is that being driven by asset turnover? And then we can break down profit margins into gross margin, operating margin, net margin. There's a lot of different drivers on the income statement that could lead to higher profits or lower expenses. Same way with asset turnover. Those are great questions for management teams if you get a chance to talk to investor relations. I can't recall if I talked about this or not, but you're all deputized. As of this moment, you're an official financial analyst working for. The name of my company is Two West Advisors. So you're all analysts of Two West Advisors. For the purposes of reaching out to your investor relations. So you can pick up the phone, you can call investor relations and say, hey, I'd like to schedule a 45-minute call. And they will talk to you. And you can ask them any question that you want to ask them about their financials, their business model. Great questions are, tell me about any trends that you're observing in these ratios and what the underlying drivers are. And the investor relations team will work with you. And they're all very knowledgeable and they get paid to do this. And generally speaking, it's a positive thing for their stock prices. It supports the valuation ratios and kind of the way Wall Street works. And I would encourage you to schedule those calls. Schedule those calls for close to the end of the semester because you want to be as knowledgeable as you possibly can before you talk to an investor relations person. And also listen to a couple of earnings calls before you do. Every quarter, companies that trade publicly, they have to have an earnings call. And those calls are available to the public. You just dial in. You can listen to them on the web, and you can ask questions directly of the management team at the end of those earnings calls. Pay attention to the questions that the professional analysts are asking, because that's going to be very telling. It's going to be very telling about what they think the most important, questions are, and that's going to lead to what the drivers of value are. This is a great chart. Star this one and look for all of these ratios in some of those databases that I pointed out. Last week, we talked a little bit about the cash conversion cycle for Apple and maybe one or two others. But these all map back to return on average, return on assets, excuse me, financial leverage, and then, so profitability, gross profit, operating profit, profit margin, productivity, we talked about. Well, we talked about the cash conversion cycle last week, then we also had property, plant, and equipment, turnover, days payable outstanding, sales outstanding, inventory outstanding. Anytime you have a trend up or down, I want you to drill in and find what constituent component is driving the change in those ratios. And that's one of the most informing things that you can do as an analyst, is looking at these ratios relative to their own history so that you can identify any trends up or down, and then also relative to their peer group. So we need to know if Pfizer's profit margin at 16% that we looked at just a minute ago, is that on par with Merck or Abbott Labs or Johnson & Johnson? How do they compare to their competitors? And why is it higher or lower? And if you can identify the reason why, maybe they invest more in research and development. Maybe they have a geographical footprint that's more profitable. Maybe they have another segment in medical device sales that makes for that comparison be something other than apples to apples. But if you can identify the reason why, say it's more investment in research and development. Well, now the question is, can that be rectified? Is that something that the current management team can use to pivot slightly in their current strategy and charter a course that is going to create more value for whatever company you happen to be looking at? And our authors talk about that exact same conversation here. When you identify, say, lower or decreasing gross profit margins, then ask the question, what causes that? Well, here's some likely causes. Competitive intensity has increased. Uh-oh. If we have more entrants into the marketplace, that's probably not going to be a good thing for the future financials of the company. Product line has lost the field. If we're in retail, fashion trends change every 6 months, maybe more frequently. I don't know. Most of this outfit was in my closet a decade ago. So how about product costs have increased? That's the last 4 years, right? We went through COVID and then we had inflation 8, 9, 10%. Is that likely to continue? Is that likely to abate? I don't know. Those are questions that you're expected to be able to answer as the analyst. And maybe not you're expected to be able to answer, but you're certainly expected to ask the investor relations team for their opinion. Look at the Morningstar report for that opinion. Read a couple of additional analyst research reports and try to find some opinions there. And then make an argument for which one of those you think is most prevalent. Product mix, volume has declined, fixed costs have not, so on and so forth. So I thought that was a great little slide that our authors put together there. Here's the charts that I find most compelling. This one shows the S&P 500 operating expense, or SG&A margin. So what you're looking at here is that in 2013, operating expense for the S&P 500 was close to 19, call it 18.5%. And as that declines, as operating expense declines, operating margin goes up. So this is the inverse of profit margin. So expenses are going down. And if we had another chart that was showing it, you'd see profit margins going up. Prepare one of these for whatever company that you're working on, and then dive into the data and be able to explain, well, what was it about this time period from 2013 to 2022 that caused operating expense to decline so significantly? So this is 20, so really this this chart cuts off right before we start to see significant inflation. You know, 2022 was when inflation started to creep into the economy from COVID. So during this whole period of time, we were experiencing lower interest rates, which don't flow into operating expense margin. Lower interest rates flow through to net margin, but it's underneath the operating expense. So that's not a cause. But the lower interest rates were a cause of an economy that, well, I guess, they were a secondary effect of an economy that was growing very significantly, which would be the revenue line item. And we didn't see much inflation in the market during that period of time, which allowed for expenses to decline for that 10-year period. Analysis of property, plant, and equipment. So this slide details sales divided by property, plant, and equipment. It gives you some indication of how efficient your PP&E is generating sales on the company's behalf. I starred this slide because I like these what ifs. If you see that number increasing or decreasing, it might often be attributed to divesting of unproductive assets, joint ventures, divestiture of production facilities, sales and leaseback of administrative buildings. Look for those things. If you see that ratio changing, look for one of those things. And if you've had some of that activity, then it'll point you in the right direction. And you can find all of that in the 10K. Most of this information that you're looking for, most of these questions that you have can be answered in the footnotes of the 10K file. So one of my favorite tips for analysts that have an interest in doing this for a living, if you have any interest at all in being a stock analyst and working as a portfolio manager, then you're going to read a lot of 10K files. And one of the best tips that I ever got for reading a 10K file is to read it back to front. So turn it upside down. If it's 80 pages long, start with page 8, go 79, 78, 77. What you will train your mind to do is identify all of the little components that the management team doesn't want you keying in on. If you start with page 1, well, you're starting with the story, the curated story of what management wants you to know about their company. And obviously, management has every incentive in the world to put their best foot forward. If there's something going on inside that business that they don't want you to know about, but they're legally required to disclose, where are they going to put it? They're going to put it in the smallest print that they can legally put it in at the back of that book. So just start there and see if you can ferret out any information that's. Now, it takes a special mind to do that, because if they're trying to bury something, they're also going to try to bury it in the most boring material that they can surround it with. So it takes a trained eye to scope out anything that might be a little untoward, or if there are shenanigans going on. But it's a great tip. I started utilizing it when I got into this industry, and I've never stopped. Okay, next we're going to move into a concept that might be very relevant to many of the companies in this room that we're working on, which is the distinction between return on assets and return on operating assets. What's the difference between assets in general and operating assets? Yeses. Somebody's got to guess for me. That's another reason why I have all the cards. It's like I can call on you now. At least you're at the top of you're at the top of the pile. What's the difference between an asset and an operating asset? Yeah, it's not a trick question. You just nailed it. A little interaction helps me out. I think I'm talking to myself after a while. So operating assets. Let's go back to Apple. A few years ago, there was a big controversy in the world of investing about Apple because they had gotten so valuable. They had sold so many phones, so many apps through their store, so many music downloads. They had accumulated, I forget what the number is, some unbelievable amount of cash, several $100 billion in cash. And all the Apple shareholders wanted to know, what are you going to do with that cash? You're going to take that cash and buy another business that you can fold in. You're going to take the cash and return it to shareholders, which would be a dividend. You're going to take that cash and buy more shares back. What are you going to do with all that cash? And management team didn't have a good answer, or they were just being discreet and they wouldn't tell anyone. So that's a good example of the difference between an operating asset and a non-operating. Because the cash was just there. It wasn't a part of their business. It had no strategic complementarity. There had no strategic purpose for Apple when it came to managing their ongoing affairs. So we in the world of finance, as a financial analyst, what you might be tempted to do, this is anybody ever see Barbarians at the Gate? Barbarians at the Gate is a movie about the takeover, the hostile takeover of RJR Nabisco. And in the world of private equity and hostile takeovers, one of the most common playbooks is to identify a firm with non-operating assets that are of significant value, where you can take that firm over, you can wager a proxy war, you can gather enough votes, you can vote yourself into the boardroom, take over the company. Once you've taken over the company, you can sell off all the non-operating assets. And what you're left with is the core business. You're left with only those assets that are required to keep producing the next widget off the manufacturer. Whatever that business makes, whether that's a good or a services company, you're only left with those assets that are core to that production. Everything else you can sell. And I can point to hundreds of examples over the last 50 years of transactions that have taken on this exact form, because Wall Street has a tendency to lose focus on non-operating assets. Okay. Because this phenomenon exists, we as financial analysts like to differentiate between operating and non-operating assets. And the more relevant number to most financial assets is the return on operating assets, because that tells us as analysts how profitable the core business is. Everything else, all those non-core assets, those can be scattered easily. We could sell those, we could take that cash, we could redeploy it in more productive assets, we could hire more sales staff, we could build more factories, we could invest that money back into the core, or we could pay it out as a dividend. And then our shareholders could take that cash and redeploy it themselves. So we differentiate between assets and operating assets, and that's where we're going to go next, because identifying an operating asset is not as easy as it sounds. Conceptually, I just laid it out. Technically, it's given students a lot of problems in the past. Okay, let's see where I want to go. Okay, before I get into a breakdown of operating assets versus non-operating assets, let's look at the equation for RNOA, which is the return on net operating assets. I think we could have done a little bit better with that abbreviation, but bear with me. The numerator is net operating profit after tax, and the denominator is there in the average net operating assets, but you could just use net operating assets. So star that formula, you'll be asked to put it to use in your homework and likely exam. And we'll take a little deeper dive here into operating assets and operating liabilities. So most of these underneath the operating asset column should look very familiar. An operating asset is probably something that's going to be identical across balance sheets for most of the companies that we're working on here. When you're in the world of accounting, accounts receivable, inventories, prepaid expense, property, plant, equipment, those are in all of our accounting problems. Those are standard. So because they're standardized, that's an indication that, okay, those are probably operating assets. All companies need them to exist. All companies have those same basic functions. Those are operating assets. Operating liabilities kind of fit the same mold. Anytime you have a question about whether or not something's operating, if it's outside of the norm, so to speak, that's probably a pretty good indication that it's non-operating. Here we're looking at Pfizer's net operating assets. The highlighted rows in this example are non-operating assets. And I take issue with the very first one, cash and cash equivalents. In 2022, Pfizer's cash was, well, maybe I don't think it. So 416 million. In 2021, it was 1.9 billion. Short-term investments of 22 billion. Okay, so that's not too far off from the example I just shared with Apple. They've accumulated so much cash, and they've accumulated so many short-term investments as a result of their profitability in prior years. I would guess, I don't know that for certain. But the business does not need $22 billion in cash to run on an annual basis. That's sitting there as a non-productive asset. In short-term investments, it's probably yielding 3, 4, 5%. We're going to identify that as a non-operating asset and back into that formula that was just on the prior screen by excluding those assets. Long-term investments, same thing. We get down into the liabilities and equity section, we're excluding short-term borrowings, including the portion of long-term debt, dividends payable, lease liabilities, and long-term debt as all non-operating. Everything else, core to business operations, so we're going to deem that to be an operating asset. Okay. Now that we've looked at operating assets, let's look at the numerator of our return on net operating assets, which is profit. We have profit in the numerator, but we're going to look at it in a special way as net operating profit after tax. We want to identify how profitable the business is. The business is financed by both debt and equity, but when we look at the business in isolation, we're going to ask, how profitable is this business? And we're going to look at it as if that we're all financed with equity. So we want to make that decision. We want to look at that analysis. We want to crunch those numbers without any debt on the balance sheet. And then we'll look at the debt component subsequently. Why do we do it like that? Well, we want to know how profitable the business is. And then I am very fond of the notion that we're gonna assess the talent or the skill based on that profit number, the talent and the skill of the management team running the business. They're running the business, I wanna see how profitable that business is. So we look at that as if it were unlevered, no debt. And then the decision whether or not to borrow money, well, that's another decision. That decision is best left to senior management team, board of directors. I like to see that decision left to the board of directors, bottom line. Because it's a very simple and easy financial transaction to go to the markets and borrow money. When you borrow money, you're gonna take the return on assets and you add a little leverage factor. When you add that leverage factor, you're gonna increase the return, and you're gonna end up with a return on equity that's an order of magnitude higher than your return on assets. The more debt you borrow, the higher your return on equity for the same return on asset. Which is why, when we look at the numerator, we take the net operating profit before tax, and then we subtract this term called tax on operating profit. And I'll show you how we calculate that. Okay, here again, we're looking at Pfizer. We have our net operating profit before tax, which is revenue less cost of sales. So cost of sales is a single line item. Right here, we have net operating profit before tax equals revenue less cost of sales. And then we're going to subtract off operating expense. Cost of sales is usually easy to identify because it's a single line item. Operating expenses are not always easy to identify because, well, this is another one of the frustrations about analyzing financial statements. Every single one of the income statements that you're looking at are going to be different. There's no mandate that a company call selling informational and administrative expenses, selling informational and administrative expenses. One company can call it selling expense, one company could call it admin expense, one company could call it miscellaneous expense. And you have to read the 10K to really know what that is. That's a frustration because it leads to a lot of students asking the question, well, I don't know if this is operating or not. I understand. You just have to dig into the disclosures to really find that out. Our authors highlight in blue the operating expense for us, so it gets a little easier. So when we take revenues, less cost of sales, less operating expense, we end up with a net operating profit before tax of, I don't know how to get rid of this whole thing. Well, 34,719,000,000. Now let's look at that tax shield. We know what the net operating profit is before tax. Now we have to subtract off this little term that says tax on operating profit. Tax on operating profit is equal to the tax expense from the income statement plus the pre-tax net non-operating expense times the statutory tax rate. The pre-tax net non-operating expense was everything not in the blue box. So if you take everything not in the blue box, you're really only left with interest expense. And for most of what we're working on, that's going to be predominantly interest expense. But our authors recognize that there are certain circumstances where something more than interest expense will fall into that non-operating category. But think of it as mostly in. So we're going to take, and a lot of finance class call this term the interest tax shield. We call it the net non-operating expense tax shield. Because we're accountants, I guess. So when we add back interest and multiply that times the statutory tax rate, we get a tax shield, and those numbers kind of break down like this. Net interest expense for Pfizer in 2022 was 987. And then I'm eating my own words here because Pfizer actually did have some other non-operating expenses on their income statement. Other non-operating income slash expense was 997. So when we're trying to assess that materiality concept again, if you're looking at the income statement, you see interest expense at 987, other non-operating expense at 997. Those two roughly offset. You can just look at those numbers and say, that's close enough. And forget about it. You don't need to calculate the tax shield in that instance. Because $10 million for a company with a $34 billion profit is not material. So if you're calculating this for the purposes of homework or on an exam, you can't be that rough with it because it's multiple choice, you'll end up getting it wrong. But in practice, you just discard that as wrong. Okay, here's what I was looking for. Our authors give us a good description of non-operating items on the income statement. So what you might see, interest expense is number one, but you might also see any of these other terms. Pfizer had another category that included a couple of those. Those would be some other, common non-interest expenses that you would see in that non-operating item. I started this slide, but I can't remember exactly why. This table breaks out, I think we're looking at Pfizer again here. This table breaks out the effects of a DuPont analysis, which looks at return on equity in the whole versus an operating focus. So I mentioned, if we want to assess the core operations of the business, our attention is going to be on that operating part of the income statement and balance sheet. So you can compare and contrast a little bit. Pfizer's net income was 31 billion. Their net operating profit after tax was 31 billion, so not a lot of difference there. Their average assets were 189. Their average net operating assets were 97. So that's a huge difference. So Pfizer has non-operating assets of what looks like almost $90 billion. So that's going to change that's going to change the number significantly. Well, that's the denominator. So when you double the denominator, you can see what happens. The return on net operating assets for Pfizer is 32%. The return on assets for Pfizer is 16%. So those non-operating assets are a real drag to their profitability. If your core operations are yielding 32% profit, well, what somebody advised, so I'm the CEO of Pfizer and you're the consultant. How do you advise me? Evans, you're next up on the, so you're next. How do you advise? Yeah. Come on, Vern. if you're advising me, you say, come on, Merck, you got $90 billion worth of assets on your balance sheet that are non-operating. Take those, cash them out, and put them into your core business, reinvest in your core business. What is it that Pfizer does? Well, Pfizer makes pharmaceuticals. Invest in R&D, build more manufacturing plants, buy Merck or another one of your competitors, buy GlaxoSmithKline, go on the M&A spree. Put that cash to work in assets that'll generate 32% profit margins. Because right now, they're just dragging down your 32% profit margins. And if you're not going to deploy that cash, reissue it in a dividend. That would be my advice to the management team, and you hit it, you're spot on. So that's a good example of what we're trying to get at when we break down returns and differentiate operating versus non-operating. Thank you, sir. Okay, we are pretty close to there for tonight. Let's see here, we're into the appendix. There's a few slides I wanted to point out in the appendix, but for the most part, it's complementary information. 77. Okay, when I say that NCIR ratio is immaterial, this was the slide that I was alluding to earlier. Our authors actually, they break down the data. It's clear that it's immaterial when you break down the data this way. They're looking at the S&P 500 companies. They put together a little histogram chart. 45% of the S&P 500 firms have an NCIR ratio of 1, which, if you recall the formula that we were looking at, it was multiplied. So you take the term, you multiply it times your NCIR ratio. If your NCIR ratio is 1, that term becomes irrelevant entirely. It basically means there's no non-controlling interest. For the other 405 companies, or 55%, I guess it was, have an NCIR ratio between 1 and 105, and only 9% have an NCIR ratio of greater than 1.05 or less than 0.95. The broad point being there that this very rarely matters. Okay, and then lastly, we talked a little bit about this in module 2, but it bears repeating because you will find that a vertical analysis and a horizontal analysis are 2 of the best tools that you will ever deploy as a financial analyst. And a vertical analysis is when you take the income statement and you present the entire income statement as if every account on the income statement were a percentage of sales. So you just take accounts receivable, divide by sales. Take inventory, divide by sales. Take selling general and administrative expenses, divide by sales or total revenue. So typically what you'll see is inventory is or expenses, any expense line item is going to be 8, 9, 10%, pick a number, percent of sales over time. And you want to track that number across several years. Ideally, you go back 10 years, so you have a full market cycle, so you can see any fluctuations in seasonality, you can see any difference in an economic expansion, you can see any difference in an economic contraction, an inflationary environment, a non-inflationary environment. That time period is important. And you could track the fluctuations in those variables over time. So that's vertical analysis, and then the horizontal analysis is the across time. So just star that slide. Go back to module 1, module 2 for a good example, and that's the type of thing that you can easily pull up on Morningstar and or FactSet. Okay, that's all of the key points for module 3. Supplement this lecture with the online lectures and the online reviews of the learning objectives for anything that just wasn't quite clicking. Homework 10 points out there. We will not meet in this room next week. I am out of town next week, so we'll be leaning on the Module 4 lecture that's already posted out there to the YouTube site. Let's talk a little bit about the exam. After next week, so I guess this would be next Tuesday night after class, once that we've had an opportunity to cover modules 1 through 4, once we've covered all that material, the next week, Tuesday after class, I'm gonna open up the first exam, which is just simply me logging into the My Business Course website as an instructor, toggling over to the date, hitting open, and then identifying the period of time that exam window is going to be open. And I usually set it open for 2 weeks. So you all are gonna have a 2-week period, beginning next Tuesday, to take the exam. Anytime you wanna take the exam, we don't use class time to take the exam. Take it in your own time, anytime during that 2-week period. Here's the trick. Once you go out there and you hit start exam, you have 120 minutes to finish the exam. You can't pause them. And you can't take it together because the questions are gonna come up in random order for everybody in the class. And the questions are gonna be slightly different because the software is sophisticated enough to change the numbers a little bit. So you can't take it together. I guess you could like cool up and you take it together. 2 of you could like take it together, looking over each other's shoulder for 120 minutes, and then you can take the next person's exam for 120 minutes. I haven't figured out how to solve for that yet. If any of you all know, can help me solve for that, let me know. At any rate, if it's, so it's obviously open book, open note, because you're taking this on your own time, in your own homes. If, this is where I've seen students fail. If you approach the exam with the mindset that it's open book, open note, so you don't have to study, you'll fail. The questions are technical enough in nature that you're gonna have to know most of the material. I say if you know 2/3 of the material, pretty good, where you don't have to look it up and answer the question, you'll do well. Because you'll have time to look up maybe 25 to 30% of the question. If it's any more than that, you're gonna run out of time. And you're gonna run out of time and miss the exam in a big way. I think that covers. Any questions about the exam? Material, homework, research project? Okay. Class adjourned. I will see you in 2 weeks then. Thanks, gang. Thanks, Zoom crew.
Thank you, sir.
Ben? Yeah, okay. You've been to Costa Rica 15 times? What's in Costa Rica? You have family down there? Oh, okay. Gotcha. And is it, Brent? What are you doing with a biomedical engineering degree in this class? Yeah, that's my question. Where's the intersection of MBA and biomed? I liked it. I liked it. My wife did pharmaceutical sales for a while. She really liked it. It's great business. And Mary, is that right? Okay. Bookbinding. How do you get into bookbinding? Yeah, that's cool. Well, if you ever bring anything in that you've done, let me see it. I'd love to see it. Y'all have a good night. Thank you.
Not arguing with you.
It's okay if you do.
Five. When module 4, homework is due. And that's when